Gold fell 4%, so did stocks, so did bonds. The one thing that rose, the dollar. Start with the contradiction, because it breaks the usual rule. On a normal bad day for stocks, you expect something to catch a bid. Gold or government bonds, the classic places investors hide. That day, they didn't. Stocks fell hard, but so did gold, down about 4%. Silver fell harder, around 8%. Long-term Treasury bonds fell too. The places you're supposed to run to in a sell-off or selling off alongside the thing you were running from. And yet one thing quietly went up, the dollar. Cash. So the question isn't just why stocks fell. We can explain that. The stranger question is why the safe havens fell with them, and why the cleanest bid on the whole board went to cash, the dollar. Because when gold, bonds, and stocks all drop together while the dollar rises, that pattern has a specific read, and it is not the same as an ordinary down day. Here is what that pattern usually means. Most of the time, money rotates. It leaves stocks and moves into bonds or gold. So one falls while the other rises. But every so often, that breaks down. Stocks, gold, and longer duration bonds fall together. And that is a different animal. It happens when investors are scrambling for one thing: cash. Paying down borrowed money, meeting a margin call, funding redemptions when clients pull out, all of it can force selling of whatever can be sold. And your safest, most liquid assets, gold and treasuries, are the easiest to sell. So they go too. And because the whole point is to raise cash, cash is often the asset that catches the cleanest bid, which is why the dollar caught a bid while gold did not. There's a second, quieter force underneath. When bond yields jump, gold loses some of its shine, because gold pays you nothing, and now cash and bonds pay more. So the same rate move that hit stocks also leaned on gold. Put it together, and the leading read is mechanical, not mysterious. This looks less like a simple rotation, and more like a cash-raising episode. Now, the part the scary headlines leave out, and pair each point with what would disprove it. This was not an everything falls panic where there was nowhere to hide. Look at what actually held. Defensive stocks, consumer staples, the things people buy no matter what, rose almost 2%. Utilities rose, healthcare rose, financials were roughly flat. The equal weight version of the market, where the average stock counts the same as the giants, fell barely over 1%, while the AI-heavy index fell 5%. Falsifier. If this were broadening into a deeper liquidity crisis, you would expect those defensives and the average stock to start bleeding too. So far they weren't, which says the selling was targeted, not blind. Second, the dollar rose, and a rising dollar can mean the market is reaching for quality and cash. But if it comes with funding stress, it can also become a warning sign. Falsifier. The warning sign would be a dollar spike that comes with widening credit spreads or rising dollar funding stress. Third, the damage was concentrated in the most crowded, highest duration corner, tech and the AI trade, exactly where you'd expect a cash-raising or de-risking episode to show up first. Falsifier. Watch whether the selling stays there or spreads into the defensives that held. So the honest read is narrower than the panic. Havens fell, yes, but money rotated into defensive equities and cash, which is more consistent with a crowded trade unwind than with the economy breaking. Now, the part that makes a cash grab dangerous, the difference between a one-day de-risking and a genuine crisis. A contained cash scramble can clear. Positions get cut, the scramble ends, and the correlations snap back to normal once the selling is done. The danger is when the selling is forced and self-reinforcing. If investors are selling because leverage is being called in, margin, fund redemptions, risk limits breached, then lower prices trigger more selling, which lowers prices again. That feedback loop is how a routine de-risking can tip into a liquidity event, where the problem stops being valuation and becomes, is there enough cash in the system? The tell to watch is not the stock market at all. It's the plumbing. Credit spreads, the cost of borrowing dollars, whether funding markets stay calm. We saw a true systemic version in 2008 and a cleaner market plumbing version in the March 2020 dash for cash, when even gold was sold to raise cash and the dollar spiked, because for a few weeks, nothing mattered except liquidity. So the bear case here is precise. The risk is not that the havens fell for a day. It is that if the selling was forced and credit or funding starts to crack, a dash for cash is exactly how a routine de-risking tips into the liquidity event everyone fears, with the plumbing, not the stock tape, as the place it shows up first. And selling gold to raise cash is not new. It can show up precisely when people expect gold to act like a perfect safe haven. In the 2008 financial crisis, as the system seized up, gold fell hard for stretches, even though it was supposedly the ultimate safe haven, because funds were forced to sell their winners to cover everything else, and the dollar surged. The clearest modern example was March 2020. In the COVID crash, gold dropped sharply over a couple of weeks, and treasuries briefly sold off while the dollar spiked, a widely cited dash for cash episode, before central banks flooded the system, and gold went on to make new highs months later. The 2013 taper tantrum was different, more a rate shock than a funding crisis. But it also showed how bonds and gold can fall together when yields jump. Each had a phase that looked like this: havens failing to hedge cleanly while the dollar or cash caught a bid. In some, the selling was a quick scramble, and the plumbing, credit and dollar funding held, so the correlations normalized within days. In others, the selling was forced and the plumbing cracked, and a dash for cash turned into a liquidity crisis. Same opening signature, very different endings. And the key test was whether the shock stayed in prices or started damaging credit, funding, and broader financial conditions. So which is it? A dash for cash that clears, or the first tremor of something worse? Back to where we opened. Stocks, gold, and bonds all fell while the dollar rose, a pattern consistent with raising cash, not a clean rotation. Read honestly. This tape is neither nothing nor obviously a crisis. Its outcome depends on whether the cash scramble was a one-time positioning unwind or forced selling that feeds on itself. And the verdict isn't on the stock ticker. It's in the plumbing. The three highest signal items. Do credit spreads stay calm? Does the cost of borrowing dollars stay normal? And does the cross-asset correlation snap back? Gold and bonds catching a bid again on the next down day. The rest is on screen. Whether the defensives that held keep holding, and whether the dollar's bid fades as the scramble ends. Those staying calm is what the cash grab case depends on. Those cracking one by one is what the crisis case depends on. One last thing, and it's not advice, it's plumbing. The day even gold gets sold, the question is never the price of any one asset. It's whether the system has enough cash, and that you read in credit and funding, not in the headlines. The next few sessions start to show which case the data is backing. One last thing. The hard numbers here, the moves in stocks, gold, silver, bonds, the dollar, and the defensive sectors come from market data providers and reflect one fast-moving session. So they will have moved by the time you watch this. The framework for reading them, a dash for cash, judged by what rose and by the plumbing, is AI-assisted analysis, and it can be wrong. Current cross-asset moves and credit and funding indicators may differ by viewing time. Treat them as time-stamped inputs, not as a prediction or a recommendation.